Thank you everybody for joining us today. We're going to be going through the Westbow capital offering. I'm joined here with Marcus McCran, and I'm really excited to learn more about this offering. It's something that's been on our shelf for a little while. We've gotten to know the Westbow team over the last number of years. And whenever we have a client or an investor or an advisor looking for a great management team, and kind of asking about who is one of the partners that we really enjoy working with, who has a great management team for their products and their fund. A lot of the times we think about Westbow. They really hit the metrics when it comes to a great management team. They have a very strong offering, and it's one that we're really happy to support and have available to our investors. So with that, I'll turn it over to Marcus. He's going to walk us through the presentation, and I'll just turn off my video, save a little bit of bandwidth.
Yeah, thanks Corey for the intro there. And yeah, I mean, like you said, we've really enjoyed the opportunity to work along Raintree and just become really familiar and just enjoy working with them as advisors, as clients, and just the whole team has just been a pleasure to work with. And so we're going to be talking a little bit about our Westbow Capital real estate opportunity. Actually, to kind of give a little bit of background on how we started initially into the exempt market. Was with a deal we did with Raintree. So the company here, Westbow, we date back to our roots of being in the agriculture and real estate space. And just about, I think 2015, we were looking to make an acquisition of a dairy farm, and came across Raintree to start, bringing in some investors into the deal because we didn't have all the capital at the moment to close on the deal. But anyways, that was our introduction. The deal went fantastic. We exited in 2020, and it came out to being just about a 33% annualized return to investors. So, which just kind of continued us to build our relationship with Raintree. And we've done a previous real estate fund with them now, and now this is our latest real estate offering. But I mean, the history of Westbow, we date back to 1977, when Dick Westring, our founder, launched Westbow Construction essentially, and started off as a small group doing framing, contracting, and then expanded the services into full-on real estate development. And just over the years, just found the benefit of holding rentals in the portfolio long-term. Because I mean, if he's going out building to sell, and then there's some risk in that in the development world where a market can turn on you in the market cycle, and then you thought you're going to get this amount of profit by selling a place or a finished unit, and then all of a sudden the market turns. So I mean, holding those rentals, we just found that it's recession resilient and can protect against those downsides, and also just have that residual income that we can generate from the portfolio. So that's what's taken us to where we are today. Right now, it's a group of companies. We're managing over $550 million worth of assets. That number keeps climbing with additional acquisitions and new projects that we take on. Same with the number of employees. We're just constantly on a hiring spree, just to, I mean, especially now, like a bottleneck in this economy is just finding good employees that are wanting to. But I mean, we're always sourcing the best quality candidates to grow our infrastructure across a group of companies. And as I mentioned, the two main lines of our business have been real estate and agriculture development, which is then led into our real estate fund, which focuses on the acquisition and management of stabilized and value-add residential rentals. And then also by leveraging that, so there's one entity being Westbow Capital, the fund that manages the rentals, and then we can leverage that relationship with Westbow Construction, which is the developer, which can go out and actually take on the development risk of building. But within that arm, we can go build purpose-built rentals and then sell them directly to Westbow Capital to manage as rentals. And there's some synergies in doing that, which enable the fund, the investors in the fund, to get a pretty good return because of that relationship. So some of the advantages specifically about a fund like ours is that it's tax efficient. We're eligible for TFSA and RRSP investments. So typically when you're going out and trying to buy a rental property, you can't go and utilize those, tax efficient vehicles. But we've set up this fund to individuals across Canada to do that. And then, I talked about our history, over 40 years now being in the real estate space. So now you don't have to go out as an investor and try to buy and manage your own rental and potentially make some mistakes along the way. You get to leverage our expertise in the space. And so we can manage and be good stewards of your capital and put it to work for you. And then just pooling your investments with other large groups of investors. So then, we've seen the real estate market just go crazy in the last, especially a couple of years during the pandemic. And it's becoming very unaffordable to try to, for a lot of people, own a home, but let alone try to invest in real estate with a large 20% down payment or qualifying for a large mortgage. So now we enable it for $6,000 or minimum investment to participate in, it'll be a more diversified portfolio rather than investing on your own where, you might have one unit versus, hundreds or thousands of units in a diversified portfolio, which can just reduce your risk. So then the advantages of our fund in particular, it's agile, designed to adapt to market changes and efficiencies. So, we saw that particularly during the pandemic where there's just so many things happening all at once. And, given that we pride ourselves on being a fairly entrepreneurial group and just being able to respond quickly and well to manage through that, those changes in the market enable us to identify the best opportunities to acquire and be very selective in that, and then just be able to manage them well. And through the pandemic has been, very, showing our advantage come through. So we do have a very strong acquisition pipeline. So that speaks to that synergy that we have with Westbow Construction. So it enables us to buy those purpose-built rentals at a discounted price, which enables us to just constantly have a good look at what's in the market and, and utilize that synergy. We do have direct attention from senior management. So there's probably larger groups out there that are in this real estate fund space. With such large portfolios, it sometimes can be difficult for, the upper level executives to know what's going on at every single property, at any given time. So that's just our focus at, the upper level senior team, just, visiting the properties and just having a close oversight on the portfolio. We do have significant experience in Western Canada, which is why we focus on that. So first of all, why do we want to focus on residential real estate in particular? Because we've seen that's been our focus over the last 40 years, and we've just seen the resilience of it through numerous market cycles. So the main reason behind that is really people need a roof over their head. There's different asset classes within real estate you could look at, whether it be retail or commercial or office space. And you just see that they, especially during the pandemic, and they took a hit, obviously, right? Because malls were closed down or people weren't working in office space, they're working from home. So, that's the key thing. People might, sacrifice a few other things during a downturn in the economy, but they're not going to, most people, the last thing they're going to want to give up is their home and having a roof over their head to be safe for their family. So that's why we focus on it. And we've just seen those trends hold true through the data. So this year is showing rental rates since 2006, and they've just trended upwards on that chart on the lower left there. That's just comes down to a supply and demand thing. Especially with inflation, rents are going up, and there's more people coming into the country that are just putting more of a pressure on demand for housing, which just pushes rents up further. And then on that note, with vacancy rates staying fairly low, they've averaged about 2.7% since 2000. So that chart on the lower right there, that performance compared against the US, which is typically you'd view it as oh, that's a huge market, a lot of potential for residential rentals. But you can see that they actually have a significantly higher vacancy rate. On average, it's been about 8% over the last 20 years. So it speaks to the strength of the Canadian market. And particularly our focus is making sure that within Canada, now we go and be selective in the markets that we go and invest in. So these are some of the key drivers that we look for when we make a determination on which markets we want to be in and if we're going to make a go or no go decision on a property. So some of the key things we're looking for are growing population, employment growth, and diversified industries. The key thing being obviously to have housing and have rentals, you're going to want to be where the people want to be. So, and that really comes down to where the jobs are. People need to feed themselves. They need to have work. They need to generate an income to then pay their bills, pay their rent, pay their mortgage, and put groceries on the table. That's why you typically see people go into major city centers and go where the jobs are. So, I mean, we look at places where we're seeing positive growth in the number of change in the number of jobs, and that typically leads to a growing population. And I mean, at the same time, we don't want to just be in a market that has one major employer or one major industry. We want to make sure it's resilient to recession, so that if one company, major company in a market takes a dip or it goes under, or a particular industry suffers, we don't want our people moving out of our area or out of our properties and potentially be at risk there. So we want to make sure that we have good diversity in the. So the tax treatment that's unique in this particular fund that we've set up is that, so we have a trust that you can invest in, and that's where you can invest in your TFSA and our RSP. We also have a limited partnership, which is actually quite tax efficient for individuals or business owners. Say they have a holding company and they want to, well, they don't necessarily want to take cash out of their company and then get taxed on it, but they're not utilizing it within their business and they want to put it to work. So we enable investors like that to utilize the limited partnership. They can invest directly through their holding company or through their business, put that into limited partnership. That's the tax, or when income is generated off of the limited partnership, it's treated as active business income rather than passive income. So the benefit there is it will be taxed at your lower corporate tax rate, which can be 26.5% or lower, depending on where you are in Canada, rather than a 50% plus tax rate for passive investment income. So some really some great tax efficiencies there, and then also distributions that come back in cash distributions that come back to investors are treated as return of capital. So no taxes initially when you actually receive those distributions. So some of the distinct strategies that we're utilizing within this, first being that design build synergy, we like to call it. And that's that relationship between Westbow Capital's real estate fund and Westbow Construction, the developer. So that enables us to go build those purpose-built rentals, and we say sell it at a discounted price to what it would sell for in the open market. And the reasoning behind that is because when we go out and develop that property, we can save on a bunch of costs that we otherwise would have had to pay if we were selling it to a third party, such as extra holding costs, extra marketing fees, or extra realtor commissions. If we already have the fund lined up as the buyer of the property, we can save on those costs and essentially not build those into our sale price as the developer, which enables the fund to really benefit, and the investors within the fund to get a property below market value and get an instant equity increase. Next would be just renovations and renovate and reposition. So that's particularly important in this market, where you can find there's a lot of product out there across Canada, that are 70s built or 80s built, and they're great properties performing quite well, but they could even perform even better because they're just a little bit outdated and they just need to be of updates in terms of the kitchens, the countertops, the flooring, and things like that, that'll just revitalize the property. They can be well built, but if you go in and put in a small amount into a interior unit upgrade, all of a sudden, a unit that might rent for $1,000, now you can rent for $1,200 a month, or things like that add income to the property. And when you're looking at units, properties that have apartments with 100 plus units, when you increase income by $100 or $200 per unit, that makes a big difference overall when you extrapolate that across 100 plus unit properties. And next would be reposition and refinance. That could be that same strategy of just, adding some value, really making operational improvements. So another way to add income is, essentially looking to increase the occupancy rate. So if we find a property that just might not be managed as well as it could be, taking that, and we might have a little bit higher vacancies. So we go in, try to lease it up better and get more tenants in place so we can increase the occupancy rate. So now we've got a higher income. And then by doing that, it adds value because these properties are valued on how much income they generate. Now we go in and add value through increasing occupancy and increasing income. So now we can go and look at refinancing it and pulling out some of that equity that we built in the property. And then we can rinse and repeat and then go and acquire additional properties, which continues to grow and diversify the portfolio. And lastly would be newer acquisitions. And that's simply just looking for good properties and good locations where we can, essentially, 2015 or newer type properties where we can just hold them long term. There's not going to be a lot of, renovations or extra maintenance costs required because they're quite new. We can just hold them long term for cash flow and appreciation. So here's summarizing some of the properties in the portfolio. In our Fund 1 portfolio, as you can see, we're diversified across Western Canada, and those are the main provinces we do focus on, BC all the way out to Manitoba. And here's just a sample of the types of properties that we've acquired in our last fund. Just to give you an idea, I mean, we looked at anything from an 18 unit acquisition, and our biggest acquisition was 144 units. So just shows you the different scale of types of properties. We're not afraid to look at some of those a little bit lower density products. I mean, especially with the high demand for like a townhome type product or, single family homes that people will pay a premium and to rent, and then there's some strong appreciation potential. So one of the ones I want to highlight there is our last acquisition, 133 units in Bristol and Bradford, in Red Deer, Alberta. And essentially it shows our ability to go in and utilize that, reposition and refinance. Essentially, we bought it below market value. The seller was motivated because, had a few deals fall through and really wanted to sell the place. And we acquired the property at about $14.475 million. And the lender had said that they would finance it at about $17 million. So essentially we're acquiring it below what, it was actually going to be valued at. So when we then went to line up and get financing in place, so we put on short-term financing, and then we're going to roll it over to a longer-term CMHC loan to get lower interest rates and a better loan overall. And then when we came back, they actually financed it at just over $18.5 million. So I mean, a significant amount of equity pulled out, about $4 million from our initial purchase price in a few short months, just by managing it well, and then being able to refinance it under CMHC. So here's another example of how we go in and actually add value through operations. So we do work with some in the portfolio. This is also our last fund, just to give you an idea of how we go in and operate our properties. But we do work with third-party property managers, as well as our internal property management group called ProKey Living. Now, this is an example of a property that was managed by a third party, and it was managed by Colliers, whom a lot of people would be familiar with because of their big multinational firm. But essentially, we were looking at how they were performing in terms of, it was a great property and a great location in Saskatoon, but it had a little bit higher vacancy rate. As you can see, it was just hovering around 7% average for a number of months in a row. And we're like, well, we see an opportunity to manage this more effectively. So we took over property management in-house with ProKey Living. And then within a short month there, as you can see, we took it over in June. And by July, we had it down to 0.9% vacancy rate. And then the month after, we had it at 0%. So it just shows the effectiveness and efficiency of our team of focusing on, even minor, that's quite a dramatic example, but like even every single thing we like to do, maximize the profitability of every property within the portfolio. And then here's some examples. I was giving those as examples of what we've done currently in our last fund. And now here's some of the pipeline properties that we're looking to acquire shortly into our latest fund here. So one of them being, these are actually both utilizing that design build synergy strategy, purchasing from Westbow Construction. The one on the left there is Horizon Development, and that's 46 units that are currently under construction. And then as units complete, we sell them directly into the fund. So we don't have to wait for all 46 units to complete construction and then have 46 units come completely vacant into the fund. We just have them cycle into the fund as they complete, and then enables us to lease it up quickly and generate cash flow. And that enables us to buy it below market value, once again, utilizing that relationship with Westbow Construction. And yeah, essentially being brand new product with high cash flow and low maintenance expenses. It's a great opportunity to manage that type of, especially being a townhome product where there's a lot of demand for that right now. People are willing to pay a little bit higher rent on that than a traditional just apartment where people might feel a little bit crammed in, especially during the pandemic. And then the next one would be Cedarbrook. So we're actually going to acquire a group of homes in our development in Chilliwack, BC, which is where our head office is, where I actually work out of. I actually just purchased a unit in Cedarbrook myself. It's a great development. It's a master plan community, currently going through construction. And, as units complete, we'll be purchasing into the fund. And, it's a great opportunity to get into a high appreciation market. And we want to be a good balance of appreciation and cash flow markets. So BC, especially Chilliwack, we've seen tremendous appreciation in properties with, in some cases 30 to, even extreme cases, 50% year over year appreciation rates for some people's properties. So we're excited to have a good, strong, brand new rentals in a market like that coming up. And then our upcoming acquisition, which is actually set to close, assuming there's nothing that happens on delays, but this property is set to close in February. So it's in Saskatoon. It's 116 units. I've got a great neighborhood. This can kind of go under that strategy of it's a little bit older. We can go in and do some renovations and upgrades and just bring it up to current standards to, have it, it's not that it wasn't performing well right now. It's just that, there's some room for improvement to even make it perform better. And that's a blend of both apartment units and, it's nearly 50-50% apartments and then townhomes. So also some more townhome product in that. And then the one that we just closed on in the fund here in mid-December. So this is 144 townhome units, and it's got excellent cash flow in a central location in West Edmonton. And yeah, it's a good unit mix of 2 and 3 bedroom units. So we can get, with good size on the square footage, we can get some pretty strong rents on that property. And especially with the good location, it's a good area where we can have high occupancy and, an affluent type of tenant base. And so the return, in summary here, the return drivers for this fund is going to be that equity growth. Really, we can lean into that Westbow synergy by buying below market. And then that, when we buy below market value, that becomes an instant equity growth or gain or realization when we acquire that into the fund. And then when we go in and acquire our properties, we're putting a mortgage on the property. We have tenants in place that pay the rent, which enables us to pay the mortgage, which then reduces our mortgage over time, increasing the equity position in the portfolio. Next would be positive cash flow. So that's a big focus of our fund, particularly. We have a high value on cash flow, being able to pay strong distributions to investors, but that also is a good protection against the downside of, if you have a drop in occupancy rates, well, you can still weather that storm by, having high cash flow already. You can have a drop and still be able to essentially pay your mortgage and not have a risk of having to offload a property at not the most opportune time. So next would be asset appreciation. And that's market appreciation, through natural economic forces, but also looking to utilize, our construction experience to go in and do renovations and add value and force some appreciation. So in summary, the projected returns for this fund, it's got a 9 to 12% annualized return. We have included in that is a 60 cent per unit target annualized distribution that can either be taken out as cash paid directly to you, or it can be reinvested back into the fund for a little bit more growth if you don't want to take out the cash now. And on that 60 cent per unit, but it kind of the percentage yield on that depends on the unit price that you purchase in at. So I've got the highlighted issue price right now. As you can see, it increases over time. Right now, the units are at $9.70, and will be increasing in March. So still an opportunity especially within RSP season, to get that lower rate. We are an open-ended fund, so you have the opportunity to, leave it in for a long period of time, or we still advise people that this should be viewed with a lens of it being about a 5-year investment, because there are some penalties involved if you look to redeem at an earlier than 4 years. Then I mentioned the distribution reinvestment plan. Units are then purchased at a 3% discount to the unit price at that time. So a little bit of an incentive and gets you a benefit to actually utilizing that reinvestment option. The minimum investment in this fund is $6,000 into the trust, and then it's $100,000 into the limited partnership. So yeah, I mean, that's the summary of our offering. These are all the disclaimers on the security side of things with our offering, but just want to throw it back to you, Corey, and see if we have some questions I can answer.
Oh, perfect. Thank you very much, Marcus. And if any of our attendees want to ask any questions, please put them in the chat or the Q&A. A couple questions have come in, so I'll just start diving into those. What would be the the main differences between your current fund and the last fund that you launched, the other REIT?
Yeah, so I mean, the main difference is that one, I mean, you could see the size of it. It was $90 million of assets acquired, and really it came down to being like a set time horizon. It's a close-ended fund, so we only accepted investments for a set period of time, and then we, in a way, you kind of cap off how much you're going to acquire. But then we have a finite time period of when we hit, between 5 to 7 years, we have a defined exit date when we go and actually sell all the properties and liquidate everything. And then all the profits are distributed at that period of time. Whereas this fund, we wanted to make it more, generational and have a longer time horizon. So it's an open-ended form where you're basically, like I think I kind of mentioned before in the presentation here, where you have the opportunity to say you still want to operate with that, mid time horizon of 5 years and leave it in for 5 years and redeem at that time. But you can also just leave it in for 10, 15, 20 years and kind of pick the time that's most suitable for you for the redemption. So there's flexibility in that. And then just with the potential size of this fund, given that it's open-ended, doesn't have an end date for when we stop accepting investors or when we stop acquiring. So this one will have more, probably like it'll have a bigger pool of a portfolio and with some more diversity. So potentially can mitigate some risk rather than being just concentrated in just a fewer assets. This one will be significantly more diversified.
Makes sense. And this puts the ball a little bit more in the investor's court, where if they wanted to invest in it for 8 years or 10 or 20, as you said, it's completely up to them if they wanted to hold on to it as long, or however long they wanted to hold on to it. We've been going through a little bit of a unique situation the last few years in the pandemic, and I do have to ask this. I know we might have overbaked this a little bit, but how has the pandemic affected the multi-unit residential real estate market?
Yeah, I mean, we've seen actually, well, I mean, I highlighted the benefits of or residential real estate in particular and how it's recession resilient. And we've seen a lot of people flock to it during this time because, I mean, there's so many, everybody understands real estate to an extent and that it's a good investment opportunity. And, there's so many investors out there chasing to be in the real estate market. And then you've got your different asset classes. But I mean, with all these people now looking at potentially exiting or not being in the continuing to focus right now, at least at this point in time, on retail or office space, well, then there's more people chasing opportunities within residential and multifamily, which, I mean, it's great, especially if you're holding properties, pushes up prices and values. But also, like, so we've just seen a high demand right now for the product, but also particularly with the Bank of Canada continuing to, keep interest rates low. We've just seen historically low interest rates during this time, which on a cash flow basis, it's great because now you can acquire properties with significantly low debt. Now a huge proportion of your mortgage payment is going directly to principal. And then you have a higher cash flow because you have a less cost to actually service that debt with your monthly mortgage payment. But also, on a note of where we are with the pandemic and everything like that, there's been so many impacts on the economy, especially with all that money printing we were talking about, essentially the central bank increasing the money supply. Well, that's creating a significant increase in the money supply that pushes up home prices and values. Essentially, there's pretty close correlation between increase in money supply and then the increase in values of home prices. So essentially with inflation now, I mean, the Bank of Canada or the government will tell you it's, 4 to 5%. But I mean, when we're going and borrowing at 2%, and let's say conservatively, it actually is running at 4% inflation rate. Well, we're borrowing at a negative real interest rate of negative 2%. So, I mean, it's just been, and I think, especially during this time, I've heard some economists say we're probably running at, 10 to 15% inflation in reality without those adjusted numbers. So I think, especially during this time, it's super important to look at something that's going to protect you and be a hedge against inflation. So, and we see real estate being a hard asset that, with increase in money supply, increase in inflation, that's a good, somewhat of a safe haven to look to. So, I mean, those are some of the things we've seen during the pandemic, and why we still see it as a great investment opportunity, and why we still are, very convinced of our thesis of why we're focusing on multifamily.
Makes sense. And you mentioned acquiring a few of these multifamily residential buildings below appraisal value, or below what your mortgager had appraised the property at, and with a fairly high vacancy rate. The one example you showed had a 7% and then your vacancy rate, and you were able to bring that down to basically zero. How are you able to find such great properties? I mean, you just find these on MLS?
Yeah. I mean, for those that are in the commercial real estate space, like or for those that aren't, like, I mean, typically you're used to going and buying your home, and yeah, there's the MLS, and every real estate agent is going to go and blast out every property that they get to try to sell it, and then have an open house and things like that. Whereas it's a little bit different on the commercial multifamily side of things, where it really comes down to relationships, right? And who knows you in the industry, whether it be, the multifamily brokers, or, even we've had some deals come to us through our mortgage brokers as well. But I mean, they want to see the legitimacy of the buyer, right? And if you have a good relationship with a broker like that, that's constantly seeing deals come and looking to sell, they will then reach out to the preferred list before it even goes, public, or, they're going to want to make sure that they approach a buyer that has the potential of actually closing on the deal, because it's a significant process to go through due diligence and, all the cost, time, and effort to, I mean, some of these times it can take months to close a property. A seller doesn't want to go out or even a real estate broker waste their time essentially with an unqualified buyer who then can't close because they can't get the financing or can't get the, down payment in place. So it really comes down to us having relationships with the brokers in key markets that we want to acquire in. So, we're first on their list to reach out to us when they see, a potential opportunity coming down the pipeline, or an off-market deal that they can send our way, and, have our ability to take a look at it. So yeah, that's really what it comes down to.
Yeah, that makes sense. And you have your own process for that. I guess they don't want everybody on MLS who has 50 or 100 grand to buy a rental property looking at $14 million ones and trying to make a deal, which makes sense. But I did want to shift gears a little bit. You talked about Westbow construction and building a few subdivisions where you purchase some of the units and you're doing it as they're built. But how do you deal with the conflicts of interest of having a fund that's buying these properties that are bought by another Westbow company, the Westbow Construction?
Yeah. So, I mean, the main thing is being that they're related entities, because we have management. I mean, Dick and Nick Westering are management on both companies. So we do want to keep a sense of independence between the two, so that anything acquired by the fund is actually done at an arm's length. Like, it's done with a sense of independence, so that we can't just buy anything that Westbow Construction builds. It's actually got to go through a review process, so that, our independent review committee signs off on anything that we acquire, especially directly from Westbow Construction, to make sure that, yeah, it's in the best interest of the investors and the fund at a whole. And, they don't have any involvement with Westbow Construction, so they don't care how if it's, if we would look at it and want to sell it to the fund. It's like, no, it comes to make sure that there is integrity, right? And, that we protect the investors and make sure that, not saying that we operate without integrity, but it comes down to making sure that there's safeguards in place. So like that investors can know and trust the process that, there's always going to be a decision-making process and hierarchy to make sure that, we can't just go and buy anything we want. It's got to pass that approval. And so that's the process we have in place.
Robust system, and there's a lot of advantages also of being able to have purpose-built rentals in your portfolio and pick them up when they're brand new. You mentioned buying those 48 units and not having to wait until all 48 were ready to get them out and leased, and that's definitely an advantage. After investing, what kind of communication should investors expect to receive? Would they get regular updates? Would they get kind of annual reporting, or what would they expect to see?
Yeah, so at this point in time, we do about 2 kind of updates, official updates that were scheduled, right? Where it's going to be, hey, here's your half year update. Here's the full year update. Just give a brief update on the portfolio, what new acquisitions have happened, and any kind of new and notable things, commentary there. And then also you'll get, obviously at that point, you'll get your financial statements to review. So we have that. And then we do have new acquisitions. We like to make sure that individuals are updated and know what we've acquired. So we typically like to do a press release on that side of things. But yeah, also times we've had, we probably increased it frequency during the pandemic, but sometimes we would go in and, especially early on when people might have been curious, how are things performing? How are things going? So we wanted to increase the frequency a little bit and maybe do like a webinar here and there where we enable people to come on and get an update, ask some questions. But then also we have for investors to actually track how things are going. They can log into the Exempt Edge, which is our online investor portal, which enables them to track, okay, well, I invested this much, this is the distributions I received, and just kind of track things on that side of things. And yeah, so we have that.
And I have 2 more questions, then we'll wrap it up. So if anybody else has any other questions they'd like to add, feel free to chat and type them into the Q&A or the chat. But now let's chat a little bit about the time frame. So I guess 2 questions. How long does the investor need to stay in the fund before they can redeem? And how long do you plan on holding each of your properties before you sell? So kind of a 2-parter, but both on the same topic.
I'll try to be succinct here. So I mentioned you want to view this as about a 5-year investment. There's a couple different series of units. Depending on where you invest, like there's kind of a sliding scale of the penalty if you redeem early before 5 years. So I can, obviously your advisor can chat through what that looks like in your specific scenario. But yeah, we like to say, view it with a 5-year lens, time horizon of investing. And after that point, because that's what we're basing our forecast returns off of is, we want to let the property work for us and for the fund, for the investors. So, 5 years is kind of that sweet spot. And then, you can look to redeem at, really at any point after, whatever time frame fits your profile. And then in terms of selling properties, we like to because we have a couple different strategies, which I highlighted here in terms of whether it's just a long-term hold, if it's a newer asset. That's something typically you're buying, you might pay a little bit more money for it because it's newer or in a great location, but then you have less maintenance expenses and you're not going to have huge capital expenditures that you might have to do in the coming years. So you can hold those a bit longer. Whereas there might be some, different markets or different types of properties where it's like, okay, it's 70s or 80s type product where, yeah, you can go in and add value pretty quickly, increasing rent. And then you don't want to hold on to it forever. Like you're not going to say, hey, I'm going to hold this 60s or 70s type property for the next 40 years. It's like, well, at a point in time, there's just going to be, a pile of expenses or upgrades required just to keep it, operational. So, we'll operate a little bit differently on that side of things in terms of holding onto a property where it might be a little bit older. So it'll vary within the fund, depending on the property type and also the market that it's in.
Yeah, and I think investing in real estate is definitely a longer term plan. And part of the reasoning to have some of those redemption charges is around planning. And when somebody is investing in property, or a fund is investing in a property that's $14 million, they don't want to have to sell that property in 6 months just to maybe do $100,000 redemption or something like that, because somebody's circumstances changed and now they need their capital back. I mean, that happens, but this is a long-term strategy. You need to give Westbow a little bit of time to acquire the buildings, grow the fund, reduce the vacancy on the properties they're buying, and let the properties do their work. Let them continue to collect rent, let them pay down the mortgage. And so I do encourage investors, if you're looking at Westbow, to think of it as a long-term investment, and it can be a great option for generating some income for retirement, generating some growth or income, or both, leading up to retirement as you're accumulating assets. And it can be a great overall investment into your portfolio. But I would encourage everybody to reach out to their advisor, and if you have any other questions, talk to them. They can also loop in Marcus if they need his help on any of those questions as well. Thank you very much for joining us.
Thanks again, Corey. Thanks everyone for joining us today, and yeah, appreciate the time, and always enjoy doing these webinars here with Raintree, and for anyone that likes to attend. So thanks again.